Yo, what is good, guys? It's your boy VGOK here. I hope you're all doing absolutely amazing and are trading safely in the markets. Now, before I get into today's video, I just want to let you guys know that the mentorship spaces are getting filled up rather quickly. I've received tons and tons of messages on Instagram, regarding courses and mentorship. It's been difficult to respond to absolutely all of you in a week, but I am trying my best to get back to every single one of you. But the ones that I have, managed to reply to, I've been having calls with, and those that have DM'd me on Instagram to see how I can really help you guys to elevate your trading with the mentorship. But for today's video, we are going to be looking at, if you haven't clocked by now by the thumbnail and the video title, Fibonacci retracements and whether they actually work. We're going to be looking at how it is used as a measurement tool, how it can help us to buy at lower prices and sell at higher prices, and understand that larger players within the markets can actually manipulate prices around certain retracement levels. And of course, some juicy chart examples as well. So first and foremost, the main thing that we need to really understand about how to use this Fibonacci retracement tool is that it's used as a measurement tool. Think of it as, it's going to be like our ruler in the market. And essentially, we're going to be looking at how to measure the size of an impulsive move. Now, it's actually designed to give us an indication of whereabouts, a retracement or a pullback is going to come back to, which is what those percentages along the side of the Fibonacci retracement tool are indicating. So the following retracement levels that I have on my Fibonacci ratio are the 100%, the 88.6, 78.6, the 71%, the 61.8, the 50%, and the 0%. And for the extension levels, we do have the minus 27%, minus 41.4%, and the minus 61.8% as well. So as you can see on that example that I've shown you guys on the right hand side, we can see that the Fibonacci tool is measuring the size of an impulse in a downtrend. We can see that it's measuring the size of the impulse from this lower high to this lower low. And that is the larger of the two moves within the wave in a downtrend. So this is going to be giving us an indication of where the retracement is going to pull back to. Ideally, where the next lower high is going to be forming in the downtrend. So we want to be using these percentages on the side, using these retracement levels on the side to figure out, whereabouts we can get a rough area for the next lower high to go for those continuation style trades to the downside. So, in this scenario, looking at these continuation style trades for more sells, in a bearish market, in this downtrending market. Now, when you're analyzing within a downtrend and you measure an impulse using the Fibonacci tool, you're essentially looking for the highest possible price to sell at once price is actually pulled back. Now, remember, we're looking to buy at the lowest possible prices and sell at the highest possible prices. And in the example to the left, which you can see on your screen now, we're actually looking to find sell scenarios at premium prices. And as you can see, the ideal premium prices, which I've highlighted in purple, are going to be between the 50% and the 88.6% retracement ratios. And now, as we actually look at the flip side of things, so in the opposite sort of market, in an uptrending bullish market, when measuring an impulse, we're actually looking for the lowest possible prices to buy at, as the price is going to be pulling back. And again, remember, as traders, we look to buy low and sell high. So in the example that you guys can see to the left, again, we are looking to find buy scenarios at regions of discounted price regions, which I've actually highlighted in purple again for you guys, which again conveniently is going to be from the 50% to the 88.6%. This is a good time to think of it like, at 100% of the price, think of it like a t-shirt. You don't want to buy a t-shirt at 100% of the price. You want to buy it when there is the big sale on at the stores. You want to be buying a t-shirt at the highest retracement levels when there is, a 78% discount on that t-shirt, or a 71% discount on that t-shirt. You don't really want to be buying it, when it's still high. When there's even a 20 or 30% discount, you want to be waiting for those higher percentage discounted price regions. So from what I've actually just discussed with you guys, we've established that the retracement levels from 50% to 100% show us where we're going to be able to see good areas of premium prices and good areas of discounted prices, since we're always looking to buy low and sell high. However, let me divert your attention now to the other end of the Fibonacci retracement tool, where you can see the three Fibonacci extension ratios of minus 27%, minus 41.4%, and minus 61.8%. Now, we actually utilize these areas to give us, just general areas for our take profit or our TPs. Now, something you guys may or may not have known or come across before in your trading journey is that the retail trading community, they tend to use the 61.8% retracement level, rather a lot. They use it quite often. Now, the issue with this is that a lot of people will be trading in the exact same way. And in result, a lot of their stop losses, they're going to be grouped in, very similar areas. Now, this very fact leaves retail traders extremely susceptible to market manipulation, because the larger market participants, the market makers, the people that really drive the market, so I'm talking about the investment banks and the hedge funds, they realize this occurrence, and they actually force price into the deeper retracement levels to try and trigger out, our stop losses to be hit. Now, it's for this very reason that my preferred retracement levels that I like to use are the 71 to 78.6%. And sometimes I do like to stretch that to the 88.6% as well. And as you can see from that image on the left, which I've got for you guys right there, I've indicated that in red. And of course, on the other end of things, my first preferred TP point, if my TPs are based on the fib extensions, is going to be minus 24%, which isn't actually on there. But, sort of realize where minus 24% would be on there, it's going to be slightly higher than the more commonly used negative 27% Fibonacci extension level. So you can see the minus 27% is going to be right here. And then if I was to put in the minus 24%, so say I'll just add another one and put in the minus 24%. You can see that the minus 24%, and sometimes I even use minus 20%, just because if I'm looking to take profit in this relative area, price isn't going to always make it all the way down to that minus 27%, because it's such a widely used extension level by the retail trading community. Now we're actually going to be looking at some past chart examples for you guys. And the first one we're going to be starting off on is, of course, one of my favorites is US 30. And I'm going to draw your guys' attention to this this day right here. And this was the 5th of August. So as I zoom in onto the price action right here, the first thing that I'm going to be looking out for is, like I've identified, like I've told you guys in our previous videos, I'm going to be looking for that point of interest. And I'm on the 15-minute time frame right now. And what we can see is this last bearish candle before this really impulsive move to the upside right here. So that last sell to buy candle, that's going to be acting as our point of interest right there. And I am going to cut the chart off a bit further just to show you guys what I mean. So that was our 15-minute point of interest right there. And once we go into the 5-minute time frame, we're going to be looking at obviously our market structure, where we are anticipating where the break of structure is. Now for me, the break of structure would have to be above this point here, but as we can see, the candlestick bodies don't actually close above this area here. They don't actually close above this area here. We only get a wick above this area here. Now if we were to go down onto the 1 minute or something, we may be able to see that, but even as we go into the 1 minute, it's still not, obviously, it's not obvious that we're going to be seeing this as a definite break of structure. But going back to the 5 minute, as we zoom in and as we forward the price along, we can see that we get it coming into that initial 15-minute point of interest like we just identified there. And as we see how price reacts, we do see now from this movement onwards, so from here to here, this impulsive move here has definitely given us, you know, that break of structure. So that's great. You know, we've identified our break of structure. So let me just play it on a little bit more. Right there. So we've got our impulsive move. That's great. So now we have our impulsive move. We're now able to actually use that Fibonacci retracement tool. So we're going to be looking to measure this impulsive move to the upside right here. You know, there's a couple ways that you know, people will use Fibonacci's, these Fibonacci retracement tools. I personally like to draw them from wick to wick, so that wick there to that wick there. And I know some people do like to draw them from the body to body as well, like so. But for me personally, I just prefer to do it wick to wick. I'm not sure why, it's just a personal preference. But yeah, I like to draw them from wick to wick, just like that. So we've got our Fibonacci sort of measured out, and you know, we can start to see where we're expecting to see these discounted levels of price as price comes back, pulls back into these regions and gives us our retracement, and we look to have that continuation movement to the upside for further buy scenarios. So as we look to forward the price, let's see where this actually pulls back into. And there you go, it comes into the 61.8% right there. And we're getting a slight reaction. It does come lower again to retest the 61.8. And eventually, there we go, after that moment right there, we do see it breaking structure. So as I extend that, we'll be able to see the price action a bit easier. You know, you can see that we've got a high, a low, a lower high, and then it's a slightly lower low in these regions here, or you could class these as equal lows. But the fact is that this is going to be a significant area. If this gets broken to the upside, which it has done now, you know, it has broken this to the upside, then, you know, we are valid to go for further buys. So, you know, you'd be looking to place, you know, your buys. We've got that positive movement away from the structure. We're looking to place the buys, stop loss below the lows right there. And again, you could even draw another Fibonacci sort of retracement right here again, you know, if you wanted to. It's the same sort of thing that's applying. We've got our next impulsive move to the upside from here to here. It's broken this piece of structure right here. So, you know, if we were to draw another one out, you're drawing it from this low of this impulse to the high of this impulse right here. And as you can see, you know, the general area of where we're looking to gain our entry is around that 71 to 78% retracement. So as I forward the price once more, okay, so there was a slightly higher impulse right there. It went to, so let's keep it accurate. And then it starts to retrace, and it gets into our 71 to 78% retracement very, very nicely right there. And as we see the price movement, how it reacts, and obviously, you know, you'd be looking to target in these extension levels, or if you have other targets that you'd like to look at based on previous structure or whatever it is, you know, you'd be looking to target, say we target these equal highs right here. And as we see how price progresses, speed it up a bit. So as the price progresses, we can see that it eventually goes and hits that final, you know, that take profit point that we were looking at. And, you know, at the end of the day, we've achieved a 1 to 12 risk to reward ratio, which is absolutely fantastic. So that was the first sort of chart example I wanted to show you guys and go over with you guys. The next one, which I'm going to be going over with you guys, is on GBP JPY. So moving over to GJ, and let's move it over to the, I believe it's actually a 1 minute time frame, and it's from yesterday's price action. Right over here. So looking at that 1 minute time frame, what we can actually see, and let me just jump it into replay mode so we can actually have a full look at this. So right there. So just jumping into replay mode, we're going to be looking at how price reacts around here. And this is that last significant lower high that needs to be broken. If this gets broken to the upside, we can flip our narrative to be bullish. So as we see how price progresses, like that, as soon as we see this movement here causes that break of structure. So we've got our break of structure, we've got our positive impulse away, and then we are able to place our Fibonacci ratios over that, like so, and you can see as it makes this impulse, it does come back for that 50% retracement. But obviously, we like to buy at more discounted levels of price. So let's have a look at how price actually progresses straight into, you get that first sort of 50, almost a 61.8% retracement as it comes down here. And like I said, this is a very widely used area of retracement by the retail community. And it gives you that feeling that, okay, yeah, it's going to start moving away now. But we then see the manipulation come in to the market, spikes immediately down into that 71% retracement, and you see the reaction you get away from that. You can tell that the manipulation, the market makers are really manipulating the market in this instance right here. So as we forward the price, there you go, and as we see what happens, there you go, you get that further move away, a further break of structure above this structural point right here. And you can see, look how accurate these Fibonacci ratios can be. Bang on that 71% retracement, you're getting that pullback, and then it's on its way further. And once you've seen that movement away, if I was to just hide this for a second right now, this was that 71% retracement. It gives that positive reaction. It actually breaks structure once again above this point here. You could actually go again, put another Fibonacci on there, right there. And in this case, it does attempt to come into that 61.8% retracement. But in this case, that 50 to 61.8, it gets into there and then goes off once more. And, I'm not saying 50 to 61.8% is the deepest retracement I've ever seen. Obviously, we've just seen a 71% retracement right here. But think about it. It's still at a 50 to 61.8% discount of when it was all the way up here at 100%. It's 50 to 61% cheaper to buy at this point here than it was up here. So, that's still a discounted region of price. It's still a very good discount to be buying at. And then, you're getting your gains as price progresses and moves further on. And as we forward the price, you can see how aggressive it actually moves away from that area. And there we go. Now, the third sort of example is going to be on GBP JPY once again, and just literally immediately after that example I've just shown you guys, another sort of time where I really enjoy and really like to use Fibonacci retracements is to form my points of interest, essentially. Now, when you have really volatile times in the market, you're going to be seeing instances like this where you're going to see a massive spike down, and then it really pushes back up again. So I'm going to show you what I mean right now. Let me just jump into that replay mode once again. So we've got another new impulse to be measuring. We've got this really aggressive spike down and a really aggressive move up, but there's not really any institutional candles. There's no sort of rally-based rally sort of demand zones to base any points of interest off of. Now, I don't do this a lot, but when we see candlesticks that look like this, I like to use Fibonacci's to form my points of interest. Now, how I like to do this is same as always when drawing out my Fibonacci retracements. We've identified that this is the impulsive move, so from the bottom of this wick over here to the top over here, and what we're going to actually do is measure it out once more with the fibs, so from the low to the high. And immediately after we've made that low to high impulse, it comes down in for that 50% retracement. But there's no really sort of there's no good institutional candles or anything to base a point of interest off of in this area right now. All we can go off right now would be probably the 71 to the 88.6, or maybe 71 to 78.6. So if I was just to draw out a rough point of interest from this area, let's do this just for argument's sake. The 71 to the 88.6% right there. And now as we watch how price retraces and if it does get into our preferred zones, let's see. Eventually it does come lower, and let me extend this out so we can see. As you can see, it comes pretty much bang on into that 78.6 retracement, and we're on the 1 minute time frame right now. So as you can see, we can see from now we have this impulsive move away from our point of interest. That means we've got a good movement away, a good reaction from our point of interest for buyers. So theoretically, what we should be able to do is place more buy entries upon this price action. And again, you could be using fibs once more. We've been given another new impulsive move. You can see, we've got a high, a low, a lower high, a lower low, lower high, lower low, lower high, lower low. We've got all these minor lower highs and lower lows in here, but the major one is going to be over here. And we can see once this movement up happens right here, you can see these candlestick bodies right here. The candlestick bodies actually close over here, and that is above these candlestick bodies. So technically for me, that is going to be a break of structure, a valid break of structure. But there are these other lower lower highs here that do get broke very easily within this movement up right here. So based upon that, we've got our confirmations. We're now allowed to be going for these buy entries. So having a buys around there, stop loss just at the lows right there, or maybe slightly below for spreads. Looking at a 4 pip stop loss on GBP JPY, which is absolutely amazing. And you could be looking to target that structural high once more right there. So that previous structural high that it made right there. And we're looking to a good 1 to 4, almost a 1 to 5 risk to reward ratio right there, which is amazing. So let's see how this would have played out. As we see, price within this candle gets into our entry. Let's see what happens. It does go a bit lower, starting to get scared, and then we do have a very nice candle giving us that positive direction away from our entry. Bit of a pullback there, but it does end up like a bullish candle. Next candle goes above these highs, but it's still not closing above. And then this is just all about being patient now. And there you go, that's TP hit 1 to 4.78 risk to reward ratio. And at this point, you could close out some sort of partial profits at this point, and then move your entry to to either a reduced stop loss, or you can have it at you could just keep it there. Or personally, at this point, I would be moving it above entry to make it a risk-free trade to see if it does go any further. And as you can see, as we forward the price along, you can see how it happens. So price does come back to entry, but then eventually overnight, as the New York session develops, it depends when you've been moving your stop. For me, I probably would have been out of that at break even, and only taken my profits at TP1, taking my partial profits at TP1. But as you can see how price does develop, it does go on further to go. I think eventually it does go on higher. There you go. It does go higher to go above this high eventually. But to be honest, by the end of it, we've closed out on a 1.1 to 4.5 risk to reward ratio, which is still good. So there we have the video on Fibonacci ratios and if they actually really work. If you enjoyed this video, please do give it a like and a comment, and hit that subscribe button as well. I hope you guys have really learned and gained value from this video too. So with that being said, I'll catch you guys in the next video for more of that trading source.